Okay, so thinking about putting some money in the market for the next decade, huh? But who knows what's going to happen, right? Boom times, bust, something in between.
The big question.
Yeah, the big question. Well, today we're going deep on stock market predictions, specifically for the U.S. market, the S&P 500,
Right.
We've got some really interesting sources for this deep dive.
Yeah, should be pretty fascinating.
We've got an in-depth analysis from Goldman Sachs. Always love to hear what they have to say.
Always a big player.
And some insights from Vanguard, another huge investment firm.
Yeah, the giant.
And for a little contrast, we've got a super optimistic, really optimistic counterpoint from Ed Yardeni. You familiar with him?
Oh, yeah. He's definitely known for his bullish outlook.
So we'll unpack what these experts are predicting, try to figure out why their predictions are so different, and most importantly, what it all means for you, the investor, or the potential investor.
Right, because at the end of the day, that's what really matters.
Exactly. So let's jump right in, starting with, I think, the most eyebrow-raising prediction.
Okay, which one is that?
The one from Goldman Sachs.
Oh, okay.
They're predicting the S&P 500 will only have a 3.1% annual return over the next 10 years.
Wow, that's pretty low.
Right, especially when you compare it to how the S&P's actually performed historically.
Yeah, it's averaged, what, about 11% per year since 1930?
You got it. And over the last decade, a whopping 22% annually.
Yeah, so 3.1% is a pretty big departure.
Huge. So the big question is, why is Goldman Sachs so pessimistic about the future?
Well, their analysis boils down to a couple of main things.
Okay, let's hear it.
First, they're pointing to the massive market concentration we're seeing right now. The dominance of just a few really big tech companies.
You're talking Apple, Microsoft, all those.
Exactly. Amazon, Alphabet, Meta, Tesla, NVIDIA.
The names everyone knows.
Right. They're everywhere. And Goldman Sachs calls them the Magnificent Seven. And their point is that these 7 companies, they're basically calling the shots in the market.
Which is kind of scary when you think about it.
It is. Because what happens if one or two of these giants stumbles?
The whole market takes a hit.
Exactly. And that's what's called concentration risk.
Okay, makes sense. So that's one thing they're worried about. What's the other?
The other concern is high valuations. So these companies, their stock prices are super high compared to their actual earnings.
Classic risk versus reward situation.
Totally. High potential gains, but also a higher chance things could go south.
So basically, Goldman Sachs is saying that it might actually be safer to put your money in, like U.S. Treasury bonds, than the stock market.
Yeah, for the next 10 years, that's what they're suggesting.
Wow.
And their model puts the odds of that at 34%.
And they're even saying there's a good chance the S&P could lose money in real terms.
Right, after adjusting for inflation. A 33% chance of that.
Definitely something to think about. But how much of Goldman's prediction is riding on this whole Magnificent Seven risk?
It's a big part of their analysis. Just to give you an idea of how lopsided things are right now.
Yeah.
Apple, they're 700 times larger than the company at the 75th percentile of the S&P 500.
Seriously, 700 times.
It's crazy. And if you take that concentration risk out of the equation, their predicted return jumps way up.
To what, 5%?
Almost 7% annually.
Wow, that's almost double.
It goes to show you, their whole pessimistic outlook is really tied to how much power these 7 companies have.
So much influence.
Exactly.
Okay, so we've heard the doom and gloom prediction, at least from Goldman Sachs.
Right.
We've talked about diversification a bit.
Right.
And we've got this really optimistic prediction from Yardeni waiting for us.
Yeah, he's definitely got a different perspective.
But before we get to that, let's take a step back and think about, what does all this mean for the average investor? What are we supposed to do with all this information?
That's the million-dollar question. And there isn't a one-size-fits-all answer. The best approach, it really depends on your own risk tolerance, your investment goals, how long are you planning to invest?
Right, because someone who's planning for retirement 30 years from now, that's a different ballgame than someone who's saving for a down payment or something.
Exactly. So figuring out your own individual needs, that's got to be the first step.
Okay, makes sense. So let's walk through some potential options, kind of reflecting these different approaches and risk levels.
Sounds good.
So starting with Goldman Sachs, if you're buying into their prediction, you're worried about this concentration risk, what do you do?
Well, one thing they suggest is investing in what's called an equal-weighted S&P 500 index fund.
Equal weighted, huh? So how is that different from a regular S&P 500 fund?
So a traditional fund, it gives more weight to the bigger companies. The more valuable a company, the more influence it has on the fund's performance.
Okay, I get that.
But an equal-weighted fund, It gives each company in the index the same weight.
So it doesn't matter how big or small the company is.
Right, so you're not putting all your eggs in one basket.
Spreading the risk a little more evenly.
Exactly. And that can help offset some of that concentration risk Goldman's talking about.
Okay, so that's one option. What else can we do to maybe manage risk and hopefully get some decent returns?
Another approach is to diversify your portfolio with both large cap and small cap stocks.
Large cap being like the big companies, S&P 500 type companies.
Yeah, and small cap being, well, smaller companies, often with a bit more growth potential.
So like the companies in the S&P 600.
Yep, exactly.
Yeah.
The idea is that smaller companies, they might have more room to grow compared to the big established players.
Makes sense. So mixing those in can help balance things out.
That's the idea.
Now, what about Vanguard's suggestion, looking outside the U.S.?
That's something to consider for sure, especially if you're looking to really spread your risk and maybe tap into markets with higher growth potential. They're specifically highlighting the UK.
Oh, interesting. Why the UK in particular?
Well, a couple of reasons. One, valuations there are looking pretty good right now, more favorable than in the US. You get more bang for your buck, so to speak.
I like the sound of that.
Plus, the UK's economy is projected to have decent growth in the coming years, which is a good sign for their stock market.
Yeah, if the economy's doing well, the market usually follows suit.
Exactly. And there's a good mix of industries there, too. Finance, healthcare, energy, you name it. Plenty of opportunities to diversify.
So the UK is definitely worth considering. What about emerging markets? I've heard those can be good investments, but also risky.
Yeah, that's true. Emerging markets, they definitely offer potential for high growth, but they come with a higher level of risk. Political instability, economic volatility, that kind of thing.
Makes sense.
But for investors who are comfortable with a little more risk, they can be a good way to diversify. Just got to do your research.
So far, we've been talking mostly about stocks, but what about bonds? A lot of people see bonds as a safer bet, especially when the stock market feels shaky.
True. Bonds are generally considered less risky than stocks. With a bond, you're essentially lending money to a government or corporation. They agree to pay you back with interest.
Right. Lower returns, but steadier.
Exactly. So they're a good option for people who are risk averse, especially when the market's volatile.
So should someone who's like spooked by all this stock market uncertainty just move all their money into bonds?
Not necessarily. There's some trade-offs to think about. With bonds, you might reduce volatility, protect your initial investment, but you also might miss out on potential stock market gains. And if inflation is high, the returns you get from bonds, they might not even keep up with the rising cost of living. You could actually be losing money in real terms.
So it really comes back to that idea of risk tolerance.
Right. You have to weigh the pros and cons.
No easy answers.
Not always.
Sounds like diversification is always a good idea, no matter which way you lean.
Absolutely. Don't put all your eggs in one basket, right?
Exactly. So whether you're feeling cautious like Goldman Sachs, or you're ready to explore international markets like Vanguard suggests, or maybe you're feeling optimistic like Ed Yardeni, diversification is key.
It's all about spreading the risk.
So many options.
A lot to consider. So what are your initial thoughts? What stood out to you the most?
Yeah, I'm with you. A lot to process. I think what sticks out to me is like just how many different factors there are to think about.
Right.
And I think you really have to like know yourself as an investor. What are your goals? How much risk can you handle?
Exactly. It's about finding that strategy that, really fits your own situation.
I mean, this whole deep dive has been super interesting.
Yeah, definitely.
We've gone from, Goldman's pretty cautious outlook to Yardeni's like unwavering optimism.
Two ends of the spectrum for sure.
And it's amazing like how different their predictions are.
It shows you how hard it is to predict the market, right?
No one has a crystal ball.
If they do, they're not sharing it.
Right. But I think hearing these different viewpoints, even if they clash, it actually helps, like it makes you think more critically about your own choices.
I agree. It forces you to question your assumptions.
Exactly. And hopefully make smarter decisions.
That's the goal.
Yeah.
It's not about just following one expert blindly. It's about understanding why they're saying what they're saying.
And then taking all that information and making your own informed choices.
Exactly.
So we've talked a lot about the Magnificent Seven, how much they dominate the market.
Right.
But what if something comes along that totally disrupts these companies, some big revolution that shakes up the whole investment landscape?
Thinking about AI.
Yeah, AI. It's already changing everything, and it's only going to have a bigger impact on the economy going forward.
No doubt about it.
So for investors, how do you position yourself to benefit from that, from this huge technological shift?
That's the question, isn't it? AI could be as disruptive as the internet was, maybe even more.
I've heard people say that.
So if you can spot the companies that are really leading the charge, the ones that are, going to shape the future of AI.
There's a lot of potential upside.
Yeah, could be huge.
Definitely something I'll be keeping an eye on. But like we've been talking about, picking the right stocks, that's only one piece of the puzzle.
Right. Got to think bigger picture, too. How is AI going to change things? Society, the economy, the future of work.
Those are big questions.
They are, but important ones to consider, especially as an investor.
So much to think about.
A lot to digest.
Well, this deep dive has definitely given me a lot to think about. So before we wrap up, what's one piece of advice you'd give to our listener, as they try to figure all this out?
That's a good question. I think the most important thing is don't be afraid to learn. There's so much information out there, books, articles, podcasts, online courses.
And if you need help, don't be afraid to talk to a financial advisor.
Yeah, a good advisor can be a huge help. They can help you, create a plan that really works for you.
So investing, it can feel kind of overwhelming sometimes.
It can, but it doesn't have to be.
If you take the time to learn, to really think things through.
You can make smart decisions.
Well said.
Thanks. It's been a pleasure, as always.
Yeah, this was great. Thanks for walking us through all this.
Happy to do it.
And to our listener, we hope this deep dive has given you some food for thought, some new ideas to consider.
And hopefully some more confidence.
Yeah, that's key. Remember, do your research, understand your own risk tolerance, and make choices that feel right for you.
That's what it's all about.
Happy investing, everyone.